And now we are talking. Welcome back to Power Business, proudly brought to you by MTN. Today we make moves. The South African Reserve Bank has moved, cutting the repo rate by 25 basis points to 7.25%. It's a decision that aligns with market expectations, but it wasn't unanimous. The Monetary Policy Committee was a split, a signal that behind the calm headline lies a more complex economic reality. So Governor Nhlanhla cited global risk, soft domestic growth, and also easing inflation as factors behind this cut. But questions remain about what this really means for consumers, business, and investment. Joining us now is Frank Blackmore. He's economist at KPMG to help us decode the implications of today's announcement and what moves the Reserve Bank may still be considering. Frank, good to have you on the show this evening.
Good evening. Thank you.
So the 25 basis point cut was expected, but the split vote among MPC members suggests uncertainty. What underlying factors are causing this division in perspective within the SARB, or the central bank?
Well, I think when we started this year, the market was thinking this is going to be a great year. Why do I say that? Because the last sort of cuts in interest rates would have happened during this year, and that would provide a boost not only to the local economy, but also to the global economy. We'd have more demand out there as we move away from the impacts of what we saw, the war in the Ukraine and the Middle East, and the supply chain issues, and. We've had inflation for a long time. That's now gone away, and we thought interest rates were going to come in. But of course, then the Trump administration came with their sort of restrictive trade policies, and the governor mentioned in his speech this was a big uncertainty. Obviously, tariffs are not good for global growth. They're also not good necessarily for prices, because what it's trying to achieve with the tariffs is bring manufacturing back to the U.S., and of course that's costly, which means prices go up, supply chains are disrupted, and with those increased prices, there's also increased inflation. So what one saw globally was central banks holding back these interest rate cuts until more clarity around these trade sort of negotiations take place. But those have also been kicked down the road by, delayed another 90 days from the initial point at which they were instituted. And that's, of course, uncertain to the global environment. Low growth also means less pressure on things like oil. And we know if South Africa is obviously not an oil producer, so we have to go and buy our oil on the international market. Higher growth would mean a higher oil price, and then, of course, we've got to buy it with rand, and that's the other variable that the governor mentioned was risky. So international prices, what's happening to the rand, and what's happening overall with respect to growth. And there's still a lot of uncertainty around how that's going to work its way through the economy over this year.
Frank, Governor Nhlanhla highlights global threats like trade tensions and stagflation as well. How exposed is South Africa to these kind of risks, and could they derail the bank's cautiously optimistic tone?
Well, according to them,
Frank, your line is not the best there. If you can just move it around for us. So I'll take you back to our producer, Vukosi, because I think it's important that we get to speak to you on a proper line to get more clarity on this, of course, this announcement by the South African Reserve Bank, cutting the repo rate by 25 basis points to 7.25%. It is a decision that aligns with market expectations, but it wasn't unanimous. Very interesting. The Monetary Policy Committee was a split, a signal that behind the calm headline lies a complex economic reality. Governor Nhlanhla very interestingly cites global risk, soft domestic growth, and easing inflation as factors behind the cut. But questions are also remaining about what this really means for you and I, the consumer, businesses as well, and investment. Frank, I do believe we have you on a better line right now. So the central bank's revised GDP growth forecast for 2025 sits at 1.2%. Let's speak about this now. How realistic is that projection?
I think it is potentially realistic if we have this interest rate reduction and potentially another one during the course of the year if inflation behaves. I think that will give the economy certainly a boost with respect to the borrowing side is concerned. If we can sort out these global tensions as well, we can also expect more demand for South African exports from overseas, and that might provide the impetus necessary to achieve sort of your 1.2, 1.4 type % growth, depending on when these things happen and how long the economy has to sort of benefit from those changes.
Yeah. With inflation dipping below 3% in April, many are asking, is this rate cut enough to boost growth while still keeping inflation expectations anchored as well? Has this struck the right balance?
Yes, I think so. I mean, if anything, I think that most commentators think that the central bank has been cautious with its cutting. Remember, this 25 basis points is in addition to the previous cuts that have already taken place. You know, no single cut, unless it's a sizable cut, will have a large impact by itself. But every time we have a cut in rate, obviously that eases the pressure on borrowers in the economy. Businesses, consumers have more money in their pockets with which they can do other things. And I think that is the main stimulatory impact of these cuts over time.
Frank, very worrying. Unemployment remains high and sectors like mining and manufacturing are still under pressure. Can monetary policy alone help us make moves toward real recovery? Or is structural reform the missing piece here?
I think that's a good point to make. I think the governor often makes this as well. Monetary policy can't necessarily grow an economy, but they can provide a conducive environment for that to happen. You must imagine what grows economies is businesses borrowing money and then trying to make a return on that investment out in the market. And if there's large fluctuations in interest rates, as central banks decrease, cut rates, and increase rates over time, it's hard to calculate what a return you need on your business in order to, make a profit, break even, etc. So when there is a lot of volatility and a lot of change, people withhold that investment. And so what the Reserve Bank tries to do is keep inflation low and stable over time, because that's the best thing for both businesses and consumers. The other thing, of course, with low inflation is it preserves the value, not only of incomes, if you're earning an income or a wage, but also of your wealth. There's less depreciation in terms of that inflation, and I think that is, we'll probably get to it later in the conversation, one of the reasons why we want to perhaps bring that inflation target down.
Very quickly, if you may, Frank, from a consumer and SME perspective, how significant is today's move in real terms? Can we expect borrowing and spending patterns to shift?
Yes, I think this will help. It's again a little bit more reprieve, which means that people don't have to, sort of use their incomes or as much of their income to service their debt, and frees up some of that income to be used elsewhere. So you will have an impact, but as I said, it's a cumulative impact, not only this 25 basis point cut, but in addition to all the cuts that have happened previously.
Right. And that's where we leave the conversation with Frank Blackmore, economist at KPMG, helping us unpack with today's 25 basis point rate cut announcement by the central bank, what it really means for households, business, and the broader economic outlook.